Hello, many thanks for joining this webinar on the outlook for fuels. It's the latest in a series of webinars that we're doing on this year's World Energy Outlook 2018, which we released on the 13th of November. My name's Tim Gould. I'm the head of division for supply and investment, and that's one of the two divisions that makes up the World Energy Outlook team. As I said, this is the latest in a series of webinars. There are going to be two more. I just wanted to bring to your attention. On Monday, 26th of November, we'll look in detail at the new special focus on electricity included in the WEO. And a week later, on Monday, the 3rd of December, we'll be devoting a webinar to talking about the outcomes and the prospects of reaching the sustainable development scenario, which is one of the scenarios that we have in our outlook. Today, we're going to focus both on some aspects of that sustainable development scenario, but we'll also be talking about new policy scenario. The difference between the two: new policy scenario gives an indication of the direction in which we're heading based on the things that governments are doing or intend to do, so the targets, the nationally determined contributions under the Paris Agreement. So as I mentioned, that's an indication of the direction of travel. The sustainable development scenario gives us an indication of where governments, or at least many governments, are committed to move. It takes its inspiration from energy-related sustainable development goals agreed as part of the UN Sustainable Development Agenda. So in particular, a trajectory in line with the objectives of the Paris Agreement, a major reduction in the pollutants that cause poor air quality, and universal access to electricity and to clean cooking by 2030. I'm going to be saying a few words of introduction, but then I'm going to pass it across to three colleagues who will be doing the presentation and also taking your questions. Tae-Yoon Kim, Peter Ziniewski, and Christoph McGlade, all of whom are key authors of different parts of the World Energy Outlook and the Outlook for Fuels in particular. We're going to take up around half an hour for presentation, and then we're going to leave hopefully an equal amount of time to answer your questions. You could submit those questions at any point using the browser for this webinar. We won't reveal the identity of the person asking the question unless you ask us to. We'll try and cover all the questions. We have a few left over from a previous webinar that we'll come back to if necessary. If we don't come to your question, then we will do our best to follow up by email. And the slides and the webinar itself, a recording of the webinar itself, will be available on our website. So with that, I'd like to hand the floor across to the first of our presenters, Mr. Tae-Yoon Kim.
Thanks, Tim. Starting from global energy demand. Global energy demand is expected to grow by 25% between today and 2040. So how do we meet this growing energy demand? Starting with the fuel that you can see, which has perhaps the largest impact on this picture, which is energy efficiency. The rise in energy consumption would be twice as large without the impact of efficiency improvement. After this, the main event is low carbon technologies, mainly renewables, with 45% of the increase in primary demand. Renewables swap places with the coal in the generation mix. The share of renewables increased from 25% to 40% by 2040, and coal moves in the opposite direction. Gas, over 80% of growth in demand comes from developing economies, with China playing a leading role, a story that we will come back to. Industry is the main driver rather than power. Gas is an increasingly valuable way for industry as a way to generate high temperature heat and as a raw material for a range of chemicals such as methanol and ammonia. For oil, stronghold of oil demand in transport is coming under attack from fuel efficiency improvement and fuel switching, but oil demand still grows. Oil use for cars starts falling back from the mid-2020s at the global level, but that's only one part of the story. Rising demand for road freight, trucks, aviation, shipping, above all petrochemicals, means there's no peak in oil demand in this scenario. Finally, there's the coal. structural decline in advanced economies, including China, where coal consumption falls by equivalent of European Union's coal use today. But this is offset by the growth in parts of Southeast Asia and in India. Let me start with the outlook for oil market. Start with the oil demand. The passenger car segment is the largest consumer of oil today. We now have roughly 1.1 billion passenger cars on the road, and this number is set to grow by 80% to almost 2 billion by 2040. In theory, this should push up oil demand for passenger cars by 80%. However, there are strong forces that push down oil demand in this sector. There's an impact from the uptake of electric cars, natural gas vehicles, and biofuels. The 300 million electric cars on the road in 2040 displays around 3.3 million barrels per day of oil demand. And fuel switching to natural gas and biofuel displays another 2.5 million barrels per day of oil demand, in addition to the amount they are displaying today. But what makes a difference is the impact of fuel efficiency improvement, which avoid around 9 million barrels per day of potential additional oil demand. As you can see on the right chart, less efficient cars. Here, higher fuel efficiency numbers means less efficient cars. The share of less efficient cars is around over 60% of total car sales today. But by 2040, this share falls to just around 10%. As a result, despite the 80% increase in the size of the global car fleet, oil demand for passenger cars peaks in the mid-2020s and then falls back to just above today's level by 2040. But this intense battle between activity growth and efficiency improvement does not happen for many other major oil-consuming sectors, such as trucks, aviation, shipping, and petrochemicals. The petrochemical sector in particular is the largest contributor to the global oil demand growth, accounting for almost 40% of global demand growth between today and 2040. Here, there's a growing attention on increasing plastic recycling and banning single-use plastics, which could reduce demand for chemical products. But in the new policy scenario, which is our main scenario, the average collection rate for recycling grows only marginally from 15% today to 17% by 2040. This is because while recycling is gaining traction in many advanced economies like Europe, Japan, Korea, but the bulk of future demand growth comes from developing economies where policies to encourage recycling is not yet widespread. So any development in advanced economies are offset by surging plastic consumption in developing economies, which is why oil demand for feedstock keeps growing at a rapid pace in the new policy scenario. In this year's outlook, we analyzed the case that there are strengthened efforts to encourage recycling across the globe. In this case, global recycling rate doubles to 34% by 2040, and this would cut oil demand for feedstock by 1.5 million barrels per day in 2040, or around 9% reduction compared with our main scenario. This 9% reduction in demand, this is a big reduction, but at the same time, demand still grows by 3.3 million barrels per day between today and 2040, suggesting a central role of the petrochemical sector in driving future oil demand growth. This contrasting sectoral oil demand outlook, slowing down demand for transport oil on the one hand and keep growing demand for petrochemicals on the other hand, has also an impact on the composition of individual oil product demand. There's a visible shift of product demand toward lighter products. The share of lighter product in oil demand was just 12% back in 1990, but it is expected to grow to 23% by 2040. This poses a challenge for the refining industry, meaning this growing demand for lighter product is obviously a challenge. But what is also important is that this pattern does not bode well with today's refining business models. Today, Refiners earn profit by selling transport fuels such as gasoline and diesel, and prices for petrochemical feedstock tend to stay lower than the prices for crude. And this pattern may not hold in the future market environment, and refining industry would need to adapt these new market realities. One way is to expand into petrochemical business via refining petrochemical integration, the trend we expect that to continue. Let's turn eyes into the supply side. Today, we might have comfortable supply, but the picture might change, and there are risks of a more lasting imbalance in market that could emerge in the 2020s. Here's the oil demand outlook in our main scenario, close to 1 million barrels per day of annual average growth to 2025. Where is the supply going to come from? As always, the need for investment not dictated by demand growth, but by the need to compensate for declines from existing fields. Declines from existing production are visible everywhere, but they are particularly prominent in mature production areas such as China, North Sea, and the Gulf of Mexico. And Venezuela is an example of what happens to production when investment dries up. Some of this gap is already in the bank. Approved projects, excluding US shale, are ramping up. Included here also an allowance for new conventional projects at the average rate that we've seen since 2015, which is a relatively low level of new project approvals, less than half of the average that we had for the 10 years prior to 2015. And that leaves a huge gap still for the US shale to fill. We already incorporated very significant growth in US shale production in our projections. But if there's no pickup in conventional project approvals, then this would mean liquid from US shale plays would need to grow to over 20 million barrels per day, adding more than 10 million barrels per day from today. And the unprecedented level of growth seen in recent months would need to be maintained for at least another 7 years. In other words, the United States alone would need to add another Russia to global supply by 2025. With a sufficiently large resource base, much larger than we assume in the new policy scenario, this could be possible. However, it would require a level of capital investment and a number of title leagues that would far surpass the previous peak. And my colleague Peter will explain some of the outlook for gas markets.
Thank you, Tae-yoon. So let's look a little closer at the share of oil and gas on a regional basis. In most parts of the world, the share of oil lies between 20 and 40% of total energy demand, as you can see on this slide. Now, if we look at the share of natural gas in the same regions, the picture becomes far more mixed. Some regions, such as Russia and the Middle East, have a greater share of gas in the energy mix than oil. Now, gas is a significant part of demand in all sectors. But in other markets, gas is mostly used in power generation with only very small shares in industry, transport, and building demand. In places like India, natural gas hardly features in the power mix at all, and there are only really small contributions of gas to industry. In the new policy scenario, the majority of regions see the share of gas demand in the total energy mix grow, despite some diverging patterns of growth. Now, for large gas resource holders such as the US and the Middle East, consumption is set to increase. For the US, cheap gas encourages more consumption in the transport and industry sectors, whereas in the Middle East, gas consumption is supported by a doubling of electricity demand, as well as growth in petrochemical capacity and the need for water desalination plants. Now, for some other more mature importing regions, gas also has room to grow its share. In Europe, gas is lower due to efficiency and renewable targets, but its share in total energy demand rises as coal, oil, and nuclear fall more quickly. For emerging Asia, the growth of gas depends to a large extent on policy. Now, in the absence of significant policy support, gas can find space to grow, but it will struggle to compete against cheaper fuels such as coal.
Now, gas demand is therefore quite price sensitive in several emerging economies, so growth really depends on the ability of an increasingly competitive global gas market to emerge and deliver reliable and affordable supply. But by far, the biggest change is in China. Gas demand there almost triples to 2040. Gas is simply a good fit for China's policy preferences, including growing attention to the quality of growth and the needs of China's growing cities. Now, there are, of course, questions over the speed at which infrastructure could be built out to support Chinese gas demand growth, and we have seen previous winters where there were some infrastructure bottlenecks. But overall, there's quite strong underpinnings for rapid growth alongside low-carbon technologies. Now, what does China and emerging Asia's rising import needs mean for global gas trade? And how will gas exports respond? Now, let's first look at what happened in 2017. Long-distance gas trade grew by nearly 10% in 2017, and most of the volumes flowed to Asia. Now, Chinese import demand grew by almost 30%, comfortably absorbing the recent ramp-up in global liquefaction capacity. This was led by Australia and to a lesser extent the US thus far. Now, healthy Asian demand left very little LNG for Europe. So you can see on the left hand there the import profile for Europe as a whole. And there LNG provided less than 50 BCM of import demand out of an import capacity of well over 200 BCM. Now, instead of importing LNG, Europe imported record pipeline imports from Russia, as well as Norway. And this was largely a consequence of lower domestic production within Europe and some greater gains for gas in power generation. Now, the indication so far for 2018 is that Europe is following a similar demand import pattern. Now, demand growth in Asia has eased concerns that there's not enough investment to close a potential supply-demand gap in the mid-2020s. So the market opportunity that we clearly identified in our projections last year has increasingly been filled. Qatar has stepped in with big announcements of new capacity. LNG Canada has recently reached final investment decision, and there are some projects on the horizon for the US. But there still is a disconnect between buyers who want maximum flexibility on contract terms, especially around volume and duration of contracts, as well as and there's this disconnect between them and sellers who need long-term commitments to be able to finance what are actually still quite very capital-intensive projects. So uncertainty about what kind of business models and contracting structures will underpin new investments is still a key uncertainty. Now, moving ahead and looking forward, how will gas trade evolve given the pivot to Asia, and will these current patterns continue? Now, looking ahead in the longer term, Russian gas comes off record highs in Europe, while piped gas from Algeria and Libya are likely to reduce as well. The import gap is filled by a more diverse set of suppliers, including Caspian gas and LNG coming from North America, particularly the US. Now, piped gas goes from 85% of imports to just around 2/3 by 2040. But globally, Asia draws in the majority of global gas supply, absorbing 80% of the increase between now and 2040, with China on track to surpass Japan as the largest LNG importer. And over the period to 2040, China in particular dominates the increase in demand for traded gas, such that gas imports reach close to those levels of the European Union. Now, moving to coal, this year's World Energy Outlook notes that global coal demand rebounded in 2017 after 2 years of decline. This reflects an uptick in demand, particularly in China and India. Now, our projections are that coal production peaked back in 2014 and demand flattens at around 5,400 million tons of coal equivalent per annum. Now, the geography of demand continues to shift towards Asia, which is already the home of 75% of global consumption of coal today. India and Southeast Asia are the main drivers of growth, while in China, coal consumption does actually fall 15% by 2040. Now, this is a result of increased attention to air quality and efforts to diversify power generation. Plus, there's a strong push for gas use in industry. Now, as a result, coal consumption in China falls by the equivalent of the EU's coal use today, but coal demand as a whole in developing Asian markets grows, meaning that the region as a whole grows by about 400 million tons. Now, the flat profile for coal still means continued investment is required. The new policy scenario implies $1 trillion of investment to offset decreasing production from existing mines and to build new coal infrastructure. Now, the majority of this is in China and India. By 2040, around 40% of coal production comes from mines which have not yet come online. Now, with that, I'll hand over to my colleague Christoph, who's going to discuss the sustainable development scenario in a bit more depth.
Thanks very much, Peter. As Peter mentioned, so far we've mainly been discussing results from our new policy scenario, which, as Tim mentioned at the beginning, is a scenario that incorporates just existing and planned policies from countries around the world. And unfortunately, these policies aren't sufficient currently to meet many of the UN Sustainable Development Goals. And so another scenario that we provide within the World Energy Outlook aims to achieve the three goals of universal energy access by 2030, a substantial reduction in air pollution, and also emission reductions in line with the needs of the Paris Agreement. And so while in a new policy scenario, oil doesn't peak anytime before 2040, coal remains largely flat, and we see a large increase in natural gas. Under the Sustainable Development scenario, we see a very different outlook for the three fuels. Coal and oil peak within the next few years, and while natural gas fares slightly better and becomes the largest fossil fuel by 2040, there is a reduction in the amount of gas that's demanded around the world. But one thing to note from this slide is that while we do have this peak in oil demand and less demand for natural gas, oil and gas still remain a central part of the energy system going forwards all the way out to 2040. And so producing and supplying these fossil fuels in the most environmentally benign manner will be a core aspect of achieving the goals of the Sustainable Development scenario. And with this in mind, within the World Energy Outlook this year, we looked at the emissions intensity associated with all the emissions coming from getting oil and gas out of the ground and getting that to consumers. And so what we can see here is all of the carbon dioxide emissions and the methane emissions that are associated with extracting the oil or the gas at the bottom of the chart, emissions from flaring, emissions from methane, transporting the oil, refining that, and then transporting the products to end-use consumers. And while this is quite a complicated chart, there's two things that really stick out from this. First of all, the emissions from combusting a barrel of oil aren't actually shown in this chart. Roughly speaking, you get around about 400 kilograms of CO2 equivalent for every barrel of oil that you consume. And so we can see, roughly speaking, on average, the indirect emissions associated with getting that oil out of the ground and to consumers adds around about 25% to the life cycle emissions, the full life cycle emissions associated with combusting a barrel of oil. But what perhaps is more telling from this graph is the very wide dispersion we see between different sources of oil around the world. For more emission-intensive sources of oil on the right-hand side of this chart, if we just take the top 10% of those barrels and compare it to the bottom 10% of barrels on the left-hand side of the chart, you have around about 4 times more indirect emissions coming from those barrels. So to put this another way, if you are a consumer and you're consuming a barrel of oil on the right-hand side, and you shifted to consuming a barrel on the left-hand side, this would reduce your emissions by around about 25%. Broadly speaking, this is equivalent to that same consumer shifting from using an internal combustion engine car on the road today to shift to a new hybrid car. And that's why we believe that supply-side dynamics have been a somewhat overlooked element of energy transitions to date. And we wanted to emphasize that this is a very important aspect of achieving the goals of the Sustainable Development scenario. So the exercise that we carried out there, that was shown for oil, we also did for natural gas. And what this showed in total is that the emissions associated with getting oil and gas out of the ground to consumers resulted around about 5 billion tons of CO2 equivalent. Broadly speaking, this is 15% of energy sector emissions today. This is an absolutely huge number. So what can be done about reducing these emissions? First of all, as you would have been able to see from that last slide, methane emissions really have a very large impact upon where different barrels of oil and where different cubic meters of gas appear on the spectrum. Reducing methane emissions is a key way to reduce the overall emissions intensity of different barrels and different sources of gas. Similarly, flaring is a key emission source that should be minimized to all extents possible. But we also looked at more exotic, you could say, measures by which you can reduce the emissions intensity of oil and natural gas. For example, one option available is to combine oil production, enhanced oil recovery using CO2. If you can capture anthropogenic sources of CO2 and inject that into the ground, that can help reduce the emissions intensity of a barrel of oil. It can also have an added-on bonus by helping to reduce the overall costs of future carbon capture, utilization, and storage projects. There's also been increasing interest around the world between co-locating renewable sources of energy and using the electricity that they generate to help provide some of the energy required to extract oil and gas from the ground. For example, solar thermal, where you use heat to extract oil from the ground. There is options available, and a number of countries are pursuing these, where you can use solar thermal sources to generate that heat and lower the overall emissions intensity of the oil. And when we looked together at all of the different options that we think are available for oil and gas companies, we saw that there's very large emission reductions are available to companies. A number of companies today use around about a $50 per ton CO2 tax when screening new investment projects and new investment opportunities. And we found that if they were to do that across all infrastructure, across the whole supply chain, across both new and existing projects, this would reduce greenhouse gas emissions by around about 1,000 million tons for CO2 and 1,500 million tons for methane. So this is a huge reduction. This would more or less halve the environmental footprint of oil and gas production. Another option available to reduce indirect emissions is to use low carbon hydrogen. Hydrogen is a key input to the refining process, and current methods of production, mainly reforming natural gas, results in a very large level of CO2 emissions. If this hydrogen were to be replaced by zero carbon hydrogen, for example, by equipping a steam methane reformer with CCS units, or if you were to use electrolyzers to produce hydrogen from electricity, this would avoid these emissions entirely and provide a wholesale reduction to the emissions intensity of many types of oil. But we've seen that hydrogen has cropped up a lot in people's attention recently, and this is because it can form a much wider role across the energy system, because it offers the opportunity to decarbonize many parts of the energy system, which can be quite difficult to decarbonize just using, for example, electricity. For example, injecting hydrogen into an existing natural gas network can lower your overall emissions intensity of natural gas and therefore reduce the emissions intensity of heating, for example. Blending is also being considered as a transitional step towards development of a pure hydrogen network or the use of hydrogen-based fuels such as ammonia. Our analysis in the 2018 outlook suggested that natural gas with CCUS units is likely to remain the cheapest way to provide low carbon or near zero carbon hydrogen, but there is an awful lot of interest in, as I mentioned, producing hydrogen by splitting water using electrolysis. I'll also mention at this point, the IEA is currently underway in producing a major new piece of work on hydrogen, which will be released sometime in the summer next year. The final opportunity to reduce emissions from oil and gas and to bypass those indirect emissions I was talking about, is to use bioenergy rather than fossil sources of energy. And one of the sources that receives the most attention today is biofuels. Today, just under 2 million barrels per day of biofuels are consumed globally. And under the new policy scenario, this grows to around about 4 million barrels per day by 2040. I should mention here that there are a number of concerns over the use of traditional ways of producing biofuels using conventional technologies. And so a lot of the growth that we see in the new policy scenario and also in the sustainable development scenario come from advanced methods of production of biofuels. These methods use wood rather than energy crops and are generally seen as a more sustainable way of producing biofuels generally. We can see that why biofuels play an important role in the new policy scenario, this role is even more enhanced in a sustainable development scenario. And this is given the need for low carbon options to decarbonize some sectors such as aviation, shipping, and trucks. But we shouldn't forget that actually the largest use of bioenergy today is for heat. And in fact, bioenergy, I'm only talking here about modern uses of bioenergy, dominates the overall contribution of renewable energy sources to heat supply. Today, around about 90% of low carbon, of renewable energy use and heat comes from bioenergy. And while this percentage does drop slightly in the new policy scenario and a sustainable development scenario, given the very rapid growth that we see in these scenarios for renewable electricity and for direct use of solar and geothermal, bioenergy remains absolutely crucial to the provision of low carbon heat to 2040. And just to finish with a few concluding thoughts on what we've been discussing here, as described by Tayoun, the links between policies, investments, and technologies, and therefore geopolitics, are becoming increasingly entwined. And this has major implications for how we view global energy security going forwards. Tayoun also highlighted the risk that there is of the tightening in oil markets around the 2020s, given the lack of new conventional project approvals we've seen in recent years. Peter mentioned that the gas markets are currently in a state of flux. With the recent LNG approvals we've seen, the risk of a sharp market tightening has reduced somewhat, but LNG sellers are still coming to terms with the new contract structures that are being demanded by LNG buyers. While it's been somewhat overlooked in the past, there's increasing attention, I would say quite rightly, being applied to the emissions intensity of oil and gas, and especially on ways in which we can reduce methane emissions coming from oil and gas operations. And finally, you will note that the title of this webinar was called The Outlook for Fuels, whereas in the past it may have been called The Outlook for Coal, Gas and Oil. And this is because alternatives such as hydrogen and bioenergy, as well as alternative ways of using fossil fuels such as carbon capture and storage, are increasingly set to become important in the future. And with that, we'll be very happy to take any questions that you may have.
Well, thank you very much, Tayoun, Peter, Christoph. We're going to move to the second part of this presentation now, where we're going to take your questions. I can see there's a few questions already coming through, and perhaps we'll start with one that deals with a question of scenario design, and this is a question about, well, clearly we've been presenting two different scenarios: a new policy scenario, which kind of takes us forward on the basis of what we can see today in the policy sphere, and then there's this alternative, the sustainable development scenario, which works back from a number of important sustainability goals, sustainable development goals around climate, air quality, and universal access. And the question is about the consistency of that sustainable development scenario with the goals of the Paris Agreement. And perhaps, Christoph, can you say a few words on that?
Certainly. So, first of all, I think it's important to note that the new policy scenario doesn't get anywhere close to the UN Sustainable Development Goals, the energy-related Sustainable Development Goals. We have an increase in, we have a slight decrease in the level of people who have access to modern energy services, but we're nowhere near universal energy access, and the level of premature deaths from air pollution remains at very high levels. We also don't get anywhere close to achieving the temperature objectives of the Paris Agreement, and that's why we have this sustainable development scenario. I think it's worth noting that within our modeling framework, we only model out to 2040, and so it's impossible for us to assign a single temperature outcome that comes from the sustainable development scenario. To understand fully the long-term temperature goal, you need to project emissions, not just CO2, but also all other emissions such as methane, N2O, etc., out over a much longer period of time. However, what we've done to understand and to develop the emissions trajectory from our scenario to see that what emission reductions are necessary is we've compared our scenario to those that are produced by the IPCC, for example, which are assessed by the IPCC, for example, in its recent special report on 1.5 degrees. And what we see from this is that the sustainable development scenario is, broadly speaking, in line with with those other scenarios that result in a 1.6 to around about a 1.8 degree temperature rise by 2100. There are also some of those scenarios in the IPCC scenario database that lead to below a 1.5 degrees temperature rise, a median 1.5 degrees temperature rise in 2100. And the sustainable development scenario, CO2 emissions, is below some of those scenarios. So broadly speaking, the sustainable development scenario is very much within the envelope of those scenarios that lead to a 1.6 to 1.8 degree scenario, but there's also some window of opportunity for the emissions trajectory to 2040 to lead to a 1.5 degrees temperature rise by 2100.
Thanks very much, Christoph. A question came in on oil demand issues, and particularly on the influence of the IMO 2020 sulfur cap on the content of marine bunker fuels. The question is, what are the implications of that going to be? Is this going to lead to a spike in diesel prices? Taeyoon, can you?
Yep. Okay. The IMO regulation to limit the sulfur content of marine fuels can have a wider impact on oil market, especially on the oil product market. And this regulation, around 2020, this regulation is likely to lead to a 2 million barrels per day of drop in high sulfur fuel oil demand. And how to fill this gap is not that easy. The one option is to use scrubbers. And this could offer a quick payback if high sulfur fuel oil prices drops quite a lot, but still there are a lot of challenges around these technologies. This is quite capital intensive and also incurs revenue loss during the idle period for installation. And the another option is to use the LNG as a maritime fuel. But likewise, this option also has a lot of challenges. There's lack of bunkering infrastructure, and it's also expensive to convert ships to use LNG. So we think the use of the compliant fuels such as low sulfur fuel oil or marine gas oil would be the most widespread options for compliance post 2020s. And this lays the prospect, a chance of a price spike in diesel around the 2020s. And this would only slacken only as new fuels are developed and scrubbers are installed across the maritime fleet. And this price increase in diesel around the 2020s would have a wider impact on the refining industry as well as the economy. The refining industries, those complex refineries with high diesel yield stand to benefit from this regulation, while those simpler refineries with high sulfur fuel oil yield will suffer from the price drop of high sulfur fuel oil.
Thank you very much, Taeyoon. There's a question on gas. So Peter, there was a reaction to the finding that the vast majority of the growth in long distance pipeline trade would come from LNG. So why do you think pipelines are at a disadvantage? I mean, surely that they're cheaper than LNG in many cases.
I think, yeah, that's an interesting question, and certainly in our projections we do see pipeline trade grow by roughly 100 BCM to 2040. But really, pipeline trade grows where it has strong political backing. So looking at bilateral relationships between, say, China and Russia, China and Turkmenistan, I mean, these have taken a long time to come to full fruition. But when they do, these buyers and sellers are locked in to long-term contracts and long-term relationships. And there's just potentially less opportunity for that moving forward because liquefied natural gas trade is growing at quite a fast rate, faster than pipeline trade, and it's amply available and flexible. And I think flexibility is one of the key watchwords going forward for the future energy system. LNG just simply fits better with the needs of that system, and there's really more of an opportunity there for a middle ground to arise. So when we talk about portfolio players and the ability to arbitrage cargoes and this sort of middle ground arising, where new business models for financing capacity can come into play. I mean, that really disconnects supply and demand and really and that market becomes more flexible. Now, of course, long-term contracts and bilateral relationships will still be very important going forward, and there will be buyers that will want to sign up for long-term contracts. But generally speaking, LNG's flexibility is going to give it the edge over pipeline trade going forward.
Thanks very much, Peter. There's a question about our projections for bioenergy. You referred to non-traditional uses of biomass. Do we still consider those as renewable or sustainable? So, Christoph, I think that's for you.
Thank you for the question. The short answer is no. Traditional uses of bioenergy were not included in the figure that I showed, and are not considered in a way as renewable energy sources that we would like to be using. Today, for example, there's of total bioenergy consumption globally, around about 45% is traditional bioenergy. So that's being used in generally speaking unsustainable ways, in providing a very large amount of air pollutants, which is very damaging to people's health. In the sustainable development scenario, the use of traditional biomass in that way falls very rapidly because of the need to achieve the rapid reduction in air pollutants, and also achieve universal clean cooking access by 2030. So the traditional use of biomass we see falling in both the sustainable development scenario and the new policy scenario, but we wouldn't consider that to be a renewable energy source in the same way that we would modern bioenergy uses, such as biofuels.
But the question was also, I mean, if it's non-traditional biomass, so if it's modern bioenergy, as you referred to, I mean, but we do consider those renewable. I mean, are there sustainability criteria involved?
Absolutely. I mentioned briefly that for biofuels, for example, today, that there are a number of concerns over the use of what's called first generation or conventional technologies. And in some countries, there are a number of concerns over whether the emissions intensity and sustainability of the cultivation of those crops is really a sustainable method of production for biofuels. That's why, as I mentioned, going forward, the majority of the growth in biofuels, both in the new policy scenario and in the sustainable development scenario, rely upon advanced technologies that use wood, for example, rather than energy crops, because there are fewer sustainability concerns associated with the cultivation of those.
Okay, thanks very much, Christoph. And Tayoun, you showed a slide on petrochemical feedstock, or the use of oil as a petrochemical feedstock. You talked a bit about what happens if we increase recycling rates for plastics. But what about the bans that are being discussed for single-use plastics in many markets? And also, why don't we see more bio-based feedstocks coming through in our scenarios?
Thanks, Tim. Yes, certainly the ban on single-use plastics would make a dent in demand for plastics, so demand for the oil demand for feedstocks. But there is a scope for cautions. So if single-use plastics are displaced in certain applications, that would certainly reduce the need for primary chemicals. But it is not that straightforward, and regulation is not very fine-tuned at the moment. For example, when you use these multi-use plastic bags in supermarkets, and this consumes much more feedstocks in making this product. But if these multi-use bags are used just 2-3 times, and then it could even increase the plastic demand. So ban on single-use plastics is well implemented, could reduce demand for plastics, but it's not very certain whether in which direction it could make an impact. So still the regulations to be improved to minimize any unintended consequences. And the second one about bio feedstocks and bioplastics. And it is true that there's a growing attention about these bioplastics. But in our models, in our projection, the cost of this making bioplastic is still too high. So there's a lot more scope to improve technologies and reduce cost. And the another challenge that bioplastic has is to secure the biomass feedstocks, especially in the context of the sustainable development scenario. And there are a lot of sectors that requires the biomass as a feedstock, for example, transport and the provision of heat, and they need a lot more biomass feedstock, and they would get a lot more policy push and helping hand from the government. And the chemical sector would need to compete with these other sectors to secure biomass feedstock in an economic manner. So that is some kind of challenges that chemical sector need to address and overcome if we are to see the pickup in bioplastic use. So for these regions, we don't have a very substantial share of bioplastics in our model yet.
The question to Christoph about the oil supply wedge that showed on the chart. There was a large amount of US shale shown on that chart. So of the oil supply wedge that US shale would need to fill in your chart to meet demand through 2025, how much of that would be production beyond what US shale producers already plan?
I think the first thing to note is that I'm sure many of you are already aware that the decline rates for tight oil wells are very, very steep. And after you drill a well, you get a large amount of oil initially, but then within 12 months, that's dropped significantly. And this is very different from a number of conventional wells. And it also means that investment trends for companies tend to cover a much shorter period of time than would be the case for conventional wells. In a conventional situation, you would invest in a project that would clearly come online within the next 3 or 4 years, and then it would ramp up the production, and you can have you can get a long horizon for that unit of investment. For tight oil, because declines are much steeper, your investment that you make within the next 12 months, within the next 24 months, you will see that oil very soon after that. And so there's very few investment plans which are really looking out, which will have a large impact on the amount of oil that is being produced in 2025. But I would say on that point, we have seen incredibly rapid increases in tight oil production in recent months, given the amount of drilling and the amount of investment that's been going into plays, particularly in the Permian region. And that would need to continue. The ramp up in investment would need to keep increasing in a similar way to what we've seen over the last period to ensure that you continue to grow production at the rates that we see. The higher the level of production is in a given year, the more wells you require just to maintain things at a plateau. And it means that you need even more wells to be able to grow production. And that's why we see that the increases in tight oil that would be required if conventional approvals don't pick up, while it's certainly not impossible, the levels of investment, the activity of drilling rigs, of completion rigs, for example, would need to reach levels far surpass anything that we've seen previously.
Thanks very much, Christoph. Peter, the question on European gas outlook. From the looks of things on that slide that you showed for the new policy scenario, European gas demand comes down in 2040 compared with today, but Europe's a very, very large gas consumer. So why is there so much gas still being consumed in Europe in 2040 in that scenario?
Well, I think that's quite an interesting question. Why gas is still plays a prominent role in the EU energy system. And the short answer is that gas still maintains a very important role in several sectors. And as Christoph mentioned before, of course, there's new alternatives emerging that can step in to provide lower carbon heating and transportation and so on. And particularly with heat, which forms a very important part of demand in Europe, gas is still a very dominant fuel. The issue really is the scale of the challenge in decarbonizing that particular sector, and having that that push is certainly a welcome step by the European Union to try and implement a energy efficiency target of 32.5% by 2030. Now that brings building demand down, for gas, but not quite at the scale where gas becomes a marginal fuel of supply. In terms of power generation, we also see gas playing a pretty key role in backing up variable renewable electricity, so wind and solar power, and that role will continue into the 2020s and as well beyond, simply because gas provides a pretty reasonable source of flexibility for those variable sources. Now, that means that over time, the capacity of gas-fired power generation will need to maintain itself at a similar level to today, whereas we'll have less fuel inputs to power generators as renewables ramp up. But gas will still need to be there as a key source of flexibility for the EU's power generation.
Okay, thanks very much. So, a question coming on the outlook for LPG. Taeyoon, what about the projections for LPG? And perhaps you could see how that looks in both of the scenarios that we've discussed.
Okay, so LPG is very much a demanded product in our projections, and it's very versatile and can be used in many sectors, from industry to transport and to residentials. In our new policy scenario, which is our main scenario, this LPG is one of the products shows very robust growth, and it is one of the major petrochemical feedstock, and petrochemical demand is keep growing, so LPG demand likewise keep growing. And LPG also make inroads in industrial applications, so there's a strong growth of LPG in our main scenario. And what is interesting is LPG also grows in our sustainable development scenario. In the sustainable development scenario, many other this product like gasoline and diesel shows a steep decline in demand. But LPG, and there's a very robust demand for petrochemicals, and there's also robust demand for industry. And also LPG make inroads in transport applications. And in particular, we assume that we achieve the clean cooking by 2030 in the sustainable development scenario. So to achieve this clean cooking, the LPG demand also increased in residential applications. So all in all, the LPG shows a positive growth even in the sustainable development scenario. So we'll gain more importance in the product mix going forward.
Thanks very much, Taeyoon. Christoph presented some of the findings on indirect emissions from oil and gas operations, and showing that wide variation across different sources of supply, and both for, I mean, I think it's true for oil, but you mentioned that it's true also for gas. So what's being done about that? I mean, are there companies that are now acting to reduce that? And why should they act? I mean, what are the incentives for companies to react to the picture that you presented there?
I think there's two key reasons as to why companies should be interested in seeking to reduce their emissions intensity. The first of all is that we're starting to see an increasing number of policies around the world which directly target the full life cycle emissions intensity of oil, and to a slightly lesser extent gas. In California, for example, they have a new fuel standard which takes into account all of the emissions associated with getting that oil from the ground by whatever technique you use, and then getting it to consumers, as well as the combustion of that oil. So the first reason is because policymakers are putting increasing attention on it, and companies will want to make sure that their fuels can be well situated within those policies and regulations. The second reason, I think, is that we're likely to see that there's, and there has already been, increasing societal pressure put on new fossil fuel infrastructure projects. And that's very much likely to increase going forwards in a number of jurisdictions around the world. And the companies or countries that can show that their oil or gas is some of the lowest emissions intensity there is will be much better placed to argue why their oil and gas should be produced over another higher emission source. So, for example, if a country or a company wanted to say, well, we can see that there is some necessary amount of oil and gas that needs to be supplied to the market. Ours is the cleanest stuff that there is available anywhere in the world. That's a fairly strong argument as to why that bit of oil and gas should be preferred over any other source. And in terms of what companies are doing about this, I think we are seeing an increasing number of efforts to tackle emissions intensities. Methane emissions in particular have received a lot of attention, and companies have been looking at ways in which they can yield substantial reductions in methane emissions. But also, I think some of the other opportunities that I discussed, such as enhanced oil recovery using CO2, integrating renewables, whether that be for electricity or for heat into the upstream, whether it's using CCS on your facilities, all of these things companies are pursuing or countries are pursuing to help to reduce the environmental footprint of their oil and gas production. And in our view, that's a trend that's likely to continue going forward as there is more increasing pressure put on for those two reasons I mentioned at the beginning.
Thanks very much. And I think we're reaching our hour of time for this webinar. So I'd like to close it there. There are a few questions which we will attempt to answer by email. So many thanks for sending all of those in. And many thanks also to Tayun, Peter, and Christoph for the presentation and for their responses to those questions. Just a reminder that we've covered, in a sense, the contribution of different types of molecules to the outlook for energy. On Monday, we will talk about the contribution of electrons. So we'll look at our special focus on electricity, which we included in the World Energy Outlook this year. And then the following Monday after that, December the 3rd, focus entirely on the Sustainable Development Scenario. So many thanks for joining us for this webinar today, and we look forward to hearing from you again. Bye-bye.